Good afternoon, everybody, and welcome to the latest installment of MSP Business School. As always, I'm Brian Doyle here. And with me today, we're missing one of the legs of the stool, so we might be a little wobbly today, Tim, right? Robb's not able to join us, but as always, I got Tim McNeil.
Yeah.
How you doing today, buddy?
Doing good. How about you?
No complaints. From a show perspective, I'm very excited today. We've got Abe Garver from Focus Investment Banking joining us. Some of you that know me might know Abe already very well, as he's done a few learning series with me over at BCIO Toolbox. And he's also our first repeat guest here on MSP Business School. And part of the reason is in talking with Abe, we're going to allow him to come on in and use our platform as he needs to. And a couple times a year, he's going to come in and do a market update on the M&A activity going on in the MSP and MSSP space and help educate us as MSPs that are looking at some potential acquisition down the line or looking to make acquisitions ourselves, and really kind of help us understand, the pros and cons and what's going on in the marketplace so we can maximize either our exits or make sure we're getting a good deal on the entry, right? So Abe, welcome back.
Yeah, welcome back.
Thank you. It feels like it reminds me of Saturday Night Live when the host gets to come back a couple times and there are people saying like 10 Pete, it's their
well, the beauty is when you do the 5 Timers Club, we get to replace your beautiful blazer with a nice, what was it, a velour robe they give those guys for the 5 Timers.
Yeah, we'll have to do it.
We'll definitely have to do that.
But it was great to talk at the beginning of the year and talk about what was going on with the M&A market and really share some inside baseball. And I've been really fortunate this year to be involved in a lot of webcast presentations, conferences, et cetera. And I will say that your audience and the engagement that I got from that conversation was just phenomenal, and I want to continue to give back any way I possibly can. And it's neat. We've had mutual clients that I've been working with come and become kind of first time clients and back and forth. So it's a really nice relationship that we have, and I love the opportunity to really give inside baseball to your listeners, and appreciate the opportunity to do it regularly.
We're excited to have you. You're your wealth of knowledge on a subject that is going to be part of almost every MSP's life at some point in time, but is also probably one of the things that we're least familiar with. As how many of us, most of us were technical founders that started a company by either choice or necessity, and we're learning as we go. Not many of us have had the opportunities to go through mergers and acquisitions. It can be a scary thought. How to finance it, how to integrate it, more importantly, and make it successful after the fact is very important. And certainly to have some experts like yourself out there that can help guide us on this information is huge. And I think Timmy would echo this, Our whole purpose for doing this is to continue to give back to the community that's treated us really well over the years and make sure that we're getting the information that folks need in a way that they can digest it. And you've been great in really sharing in a way that many people wouldn't share, very transparent in your approach. And I thank you for that. And I'm excited to hear what you have to talk about today.
Yeah. Awesome. And I'm going to start by just kind of this market update. And for those listening on podcasts, I'll read part of this, but also what I'm sharing on the screen now is Channel E to E. It's M&A deals that it's reported on so far. And as of today, we're sitting here at the beginning of October, and there's 600 plus M&A deals, tech M&A deals that Channel E to E's reported on. And you see in 2020, there were 530. So we're already outpacing last year from a volume perspective. And those 600 deals, the top category is MSPs, which we're focused on. MSSPs, the managed security service providers. I've been involved in a couple of MSSP transactions this year, and happy to kind of give inside baseball on what's going on there. And then also in this list of ours, IT consultants, kind of et cetera. So let me, so that's kind of big picture. I think it's really interesting to see, and I've pulled this, I use this kind of on some first calls as I'm orienting people to the market. This is the number of PE-backed platforms established by year, going back to 2014. And you'll see it really started to take off in 2018, which was when Ramsey, head of M&A at Evergreen Services, started to buy platforms. You see a little bit of a dip in 19, and then 20 we had 17, and we're up to 8 for 2021. And I will, so there are approximately, and you saw in that list, and I said channel E to E. I'm going to scroll over on this. There are, that I'm tracking, and these that are highlighted are MSP platforms that Focus has been involved in the catalyst for. So there's kind of 68, and I would say there are another 10 or so that I'm not aware of. So let's say there's, at this point, for the sake of the market, kind of describing it, there's 75 PE-backed MSP platforms, which is just amazing if you stop and think of it, that have done transactions, as we see just this year, with 610 companies. Some of those are platforms, but a lot of those are what are called add-ons to the platform. Each one of these 75 platforms has, will buy 1 to 2 companies per year for a 4 or 5 year period. And so that's kind of how you're getting that higher volume. But really those 68 I've identified, and another 10 probably that we don't know about, that's what's really driving the majority. And what's fascinating, what happened at the beginning of the year after we spoke, one of the first, I'll call them first generation PE-backed platforms, traded. It was private equity backed. This was Thrive Networks, backed initially by MC Partners. It did what's called a recapitalization, and a larger private equity group than MC Partners came in and bought out most of the shares that MC Partners owned, and now Court Square owns that asset, Thrive Networks, and it kind of, the whole cycle starts again, in that they made an acquisition in Europe for an MSP, and they're expanding into service now and kind of other capabilities that the business before had done less of.
So we've talked sorry to interject, Abe. So first thing, for those that are watching or those that are listening on the podcast, we'll be posting the link to the YouTube video. So if you want to see some of those common names that are inside the spreadsheet, a lot of MSPs, I think most of you will recognize, will certainly have that for you. But where I wanted to interject before we continued on, Abe, is we always talk about how there's a second bite of the apple potentially there for a lot of the business owners that are thinking about joining into a PE platform. In reverse, how the PE platform is usually looking for leadership as part of this acquisition. If I'm hearing you correctly, there's even potentially a third bite at the apple as that entity grows and outgrows the PE firm they're with. So that's probably very exciting to hear, because we've all thought of the second bite of the apple opportunity. Didn't know there could be a third.
Yeah, there's absolutely a third. And it gave us our first, in the Enable Empower presentation that I did, and AB from MC Partners was one of the presenters. He showed in their investment that MC Partners returned over 5 times its money that it invested in that MSP platform, Thrive. For every dollar it put in, it got over 5 out for its investors. And in the same fashion, on one of the first add-ons that they did to that platform, I believe rolled in the, let's call it $1.5 million range, and their exit was in excess of 5 when the transaction, kind of when that new buyer came in. But parties are absolutely encouraged, and the next buyer, the next kind of larger private equity group, really, the business is more valuable if the Robb Stevens of the world, who was the CEO and still CEO of Thrive, if he rolls money that next time, it's a very bullish, great sign to that new investor coming in. And others will look at you too the same way. It's definitely it. And what I heard from a private equity group this week, kind of talking through this, was it may be your client's second bite at the apple that they're contemplating, but from the private equity group's perspective, the 75, it's their first bite at the apple.
Yeah, I was
Nobody
actually
ever
going to
points
say
that
that
out,
same thing.
but
Yeah,
They're like,
it's in their best
"Oh,
interest.
this is our
Yeah.
first bite of the apple.
Yeah,
not the-
this is the moment we were waiting for, right?
Yeah.
Yeah.
And if I can interject there too, I think a lot of folks are with Thrive, but one of the things that, making this investment and going into the private equity world does, not only does it accelerate potentially valuations down the road, but it accelerates the ability to scale, build, and get recognized. Thrive was recognizable to me, not only because it's here in the Northeast region, I think based out of Boston, or at least with a large presence in Boston. They're part of master agent agreements. Like, I know Avant, who's a master agent. Thrive is one of the MSPs. Without that backing, without that financial stability, you don't get to be part of a portfolio that can basically just walk business into you from a lot of smaller vendors across their portfolio. So it really opens up some new opportunities. And I think that's a double-edged sword, right? That's the new opportunities for bigger guys to come in and expand and do more. And for those of you that might be on the smaller end, you got to start considering too, your competition's getting stronger. So you got to start thinking about your plan as well and what your future looks like. And if you don't see light at the end of the tunnel, you might want to start thinking about how you can start preparing yourself to get to that next phase and maybe become part of one of these private equity opportunities.
Yeah, well, and I think just to add on to that, Rob and I have a business coach who he runs peer groups within the MSP space, and we've actually had him on here before, Sean Walsh. Shameless plug. He's really good at talking to those smaller MSPs and saying, hey, like, at some point you're going to exit. Whether every MSP has an end, right? What do you want that end to be? And what he found, and what I've found with having a lot of conversations with MSPs throughout the weeks, months, and years is, there's this thought with the average MSP owner that, well, I can just deal with it tomorrow, right? I'm just barely breaking even. I can just deal with it tomorrow. But I think it's really important for any MSP listening right now to really work on your back end, on your operations, work on your profitability, so that if you do want to go down this road, that you're attractive, because there's a lot of people breaking even out there, and it's really important to things that we've talked about. It's really important to get business coaches, join peer groups, to make sure that you put yourself in a position for success in the long term, right?
You're absolutely right, Tim. That, like, peer groups, I just hear over and over again in the transactions that I've been involved with that are most successful. Investors really like companies that have been in peer groups because they're trading best practices. There historically hasn't been competition from a regional perspective, and someone on the East and West Coast can share kind of what's really working it's, it's always been in my top 5, but I'd say it's in my top 1 or 2 is like join a peer group. ConnectWise as an example.
Yeah, absolutely.
Peer groups are just incredible.
Yeah.
Meet 4 times a year, and many of in one of the articles we just published with Channel E to E, many of the platforms that are formed of those 75, more and more today they are a merger of peer groups to get to the size and scale. And if you had not invested in your peer group relationships and built that kind of organic network all along, it's hard to make that jump and feel comfortable and have really found the right partner.
Yeah. Yeah. Well, it's in a roundabout way, and maybe kind of a corny way, an investment in a peer group is really an investment in your company long term. I mean, it really is. It was for Rob and I know a lot of our clients, I would 90% at least are in peer groups currently. And I know that there are a few that are on that road to either acquiring or be acquired in the mid and long-term future.
Yeah, we've seen, I mean, as long as I've talked to MSPs, the ones that are being acquired and making the moves in the marketplace are ones that are involved with either coaches or peer groups. And those that are struggling and continue to struggle are unwilling usually to make that investment. And I think that's something for a buyer to look at, Abe, and I'd love your perspective on it as well, because if you're not willing to invest in your own business to grow it, how are you going to be the partner that the MSP is looking for in an acquisition, right?
Yeah, it's just so true. It's all day long an investor will pick a business that's been active and involved in their peer groups and is a thought leader all day long. That will be a better business at the end of the day than someone that's working in isolation, doesn't work well with others, isn't a team player. The whole kind of notion of this private equity group investing in a platform and kind of pulling peers in. And I'd love to give a shout out to this. This is really just kind of breaking news over the past couple days. And let me see if I can share it with, here is, so,
right.
This is Rashad, who's the CEO of Domain Technology Partners. And Domain and Tier 1 are, to me, just one of the best kind of textbook examples of 2 peer group members. So Domain Technology Partners, it was rebranded Domain Technology Partners, Domain and Tier 1's merger, and Frontneck backing Domain is the private equity group. They did this transaction at the end, kind of end of last year, and had been quiet for a number of, an extended period of time, and announced just a couple days ago that with other peer, kind of three other exceptional, very high operational maturity level businesses in other parts of the country. They've come together in this 4-way merger backed by Frontneck and formed an MSP, nationwide MSP called Integris. So it's really neat. I was not personally involved in this transaction, the addition of these 3 businesses to Integris, but I'm just kind of warm inside that Domain that we did help as a catalyst with the introduction to Frontneck, that this business has really now morphed, even now that it has this private equity group investment, has kind of, is doing everything that it had, planned to do at this time last year when it closed its first transaction, and it's well on its way to growing to, at some point, 2-3 years from now, have another transaction like MC Partners in Court Square. And I just credit, like, I met Rashad the first time at IT Nation in 2019. Yeah, he was clearly very well liked by his peers, active in the peer group, and he's a very very bright guy. But I credit a lot of his success to his willingness to work with his peers and be a great team player, be a great for his employees. I remember as I was getting to know him in the business, his commitment to his employees and that culture is just exceptional. He really always is kind of like a servant leader, putting them first. And I'm just delighted to see that kind of success continuing on. I couldn't be prouder.
So maybe you can expand on that a little bit, Abe. When you look at the characteristics of companies that can come into a merger like that, like, first, I'm shocked that 4 companies could come to the table together and hammer out a deal that actually makes that next step happen, right? Because there's always some complexity, and this we always talk about in acquisitions, at least from my seat, teeter-totter moves, and somebody's always leaning a little bit more in the favorable manner when it's done right. And how do you keep everybody happy? Because after it's done, everybody has to work together. It's pretty amazing that 4 groups could come together like that. But maybe you could talk a little bit about what the buyers are looking for today. So, whether it's a PE-backed company or just, somebody that is looking for, an acquisition out there, what are you seeing are the right traits for a company that might be looking to sell to have in order to make a successful acquisition?
And I'll, since we were just
right up there in front of me. Wow.
Yeah.
I knew it was coming.
It's a great transition.
I'll kind of expand on what from the buyer's perspective, what they found so appealing about Domain and Tier 1. And for smaller MSPs, smaller MSPs that are listening, this is I'm going to give 8 different things that the buyer's looking for. This is something that definitely to hone in on. One was cultural fit. So to get to this level, to take the private equity platform investment, many of the conversations I have with potential sellers, they're not yet large enough really for a transaction. And my advice is, let's find the person that you really click with in your peer group. There's a great cultural fit. There's a great kind of tech stack fit. Let's look at that. Let's look at that kind of network that you have first, and find a transaction partner that together you can be worth. We can get a higher valuation for your business and kind of increase likelihood of kind of long-term success and trajectory. So for those listening, I'll just go through the list. It's cultural fit, geographic fit, strategic fit, financial fit, low integration risk, a leadership gap being filled, an inactive shareholder being taken out, and a reduction of customer concentration. And so using Domain and Tier 1 as an example, was a great cultural fit, both in the same peer group for 10 years. They knew each other's families, they knew issues kind of in their life, they had similar challenges. Geographic fit, Domain in Princeton, in Tier 1 in Baltimore. It was close proximity. Strategic fit, the 2 businesses had expertise that the other, when put together, they could kind of cross-sell. Financial fit, without having come together, Domain was not at the size and scale that Frontneck, the private equity group, could make an investment in it. But with this partner, it was large enough. Low integration risk because of the similar tech stacks and culture. The private equity group saw and really liked that. A leadership gap being filled. The CEO of Tier 1 was retiring. So this allowed Rashad as CEO to, kind of carry the next leg of growth. And then that I add in addition, it wasn't in this transaction, but there are also sometimes passive investors, and being able to take those out is a nice place for the private equity group to come in. And then a super large one, I say here, reduction of customer concentration. I have a life sciences focused MSP that has 60% customer concentration. And the lenders, the private equity lenders, if a business has more than 20% revenue coming from one customer, that many of the lenders will not lend on the transaction at all.
Yep.
So in this case, of this hypothetical but real Project Beautiful, my client has $7 million of revenue with 60% customer concentration. And I found in the same geographic area another life sciences company that when combined, the two will have kind of 20+ million of revenue, and the customer concentration goes down to 18%. So something to be aware of, the customer concentration, it's hard. I see it very frequently. You don't want to turn away, business, especially from your favorite best customer. Investors are constantly looking at ways to reduce risk, and to the extent you can have a larger group of customers that you're not super dependent on one, it's better to build with that strategy in mind, understanding that from time to time it's going to get larger. And the life sciences companies, they didn't intentionally set out, but their whole business model is to try to get engaged and be an MSP when kind of the preclinical work is done. When their client gets FDA approval, all of a sudden they wake up the next day and there's 200, 300, 400 employees that are being added. And that's why it becomes this, very large customer. Yeah. So it's kind of unique. It's somewhat unique to the life sciences with the FDA approval. But for all the rest of us, as we think about, where you want to grow the business, it's definitely from a strategy perspective, try to have it be blended and not over, either 25, your top 2 customers should be 25% or less, or your top customer less than 20. Those are the blending.
And we've seen that 100 times. We've probably seen it more from the companies that have gotten destroyed as a result of that. They started their company with a big relationship that they may have had personally that walked them into, $500,000 or $600,000 worth of revenue that allowed them to grow. And then they maybe got it to, to $1 million. But, like you said, 60, 70% in one spot. And then all it takes is one retirement or an acquisition or just one changing of leadership for that whole thing to be taken down and it to come. And I think the MSP industry, especially those that have been in coaching, have really been educated. You say 20%, it's great to hear that number, Abe, because we hear more, never let it be more than 10% of your business.
And I would,
I'm sure that makes it a more attractive deal from your side, but realistically,
less is more from that standpoint.
Yeah, I mean, I look at my company, the beauty of selling software on my side is really nobody. It's a big animal, everybody's buying bite-sized slices. So, as some churn out and new ones come in, I'm usually on the right side of the ledger, right? But MSPs don't always have that luxury as a result of that. And it's a scary place to live when you're walking that tightrope of I need to keep everybody employed, happy, and try to grow my business. But Man,
Yeah.
I lose sleep at night with if this guy ever changes, right?
Well, and I would
Oh.
say what I've talked to a number of MSPs over the years where I think the thing that scares me for them is having a conversation with somebody who says, look, this client is, if they leave, I'm going to have to let go 4, 5, 6, 10 people. And I know they're looking. And it's just like oof. That's a tough pill to swallow. And it's just really important as the MSP, it is easy. You'd mentioned it's easy to turn around and all of a sudden tomorrow you've got, well, hey, we've got like 100 more people coming on. We just acquired somebody. Just be conscious of your client deck and where that revenue is coming from. And everybody wants to be at a profitable state, but you also want to mitigate your risk. So it's just really important to remember as you're building out your client tech.
Yeah, and I think, I think something to kind of keep in mind there too is if you're an MSP owner today, be honest with yourself.
Yeah.
Nobody's going to buy you because you're in bad shape, right? You've got to really be honest with yourself and take the steps to prepare and insulate yourself. When I hear your story, you're just talking about, Tim, with people laying off people, I immediately think about, and how many customers will I have to sell to bring that back just to get back to even before I can even talk about accelerating.
Yeah. Well, and us being on the sales side, good, bad, and different, however you want to look at it, we've had to have a number of those conversations because I think this is coming. I really got to start my sales engine. And it's like, well, okay. Yeah, you're right. You're 100% right. But, you might be 6 months too late because they need that money in 6 months. Well, it's going to be a year or more to be able to break even, let alone see the growth that you need to replace all that. So it's just always being cautious. You're always going to take chances as a business owner, but you also need to be cautious in some areas as well.
So Abe, any other thoughts you want to share with our audience in this edition? And again, you've got free reign, so come on back anytime.
Mm-hmm.
But I want to make sure that we get all the message that you had for today, as part of our podcast. But we are heading towards the pseudo end, I'll call it.
Yeah, sure. Yeah, sure. Yeah, I would say one thing that's happened, since we visited last, that I've seen in the market, a vertical that's really taken off, and I've seen some high growth companies or businesses that are focused on CMMC, the cybersecurity maturity. For those who haven't heard of this before, defense contractors and subs, both the primes and the subs, and there are about 350,000 of them in the U.S. They have to meet this CMMC kind of certification requirement, and it's an ongoing process. You get a score when the assessment's done, but basically, if you don't pass, if your score isn't kind of in the right range, it stands in the way of companies, those subcontractors, the DoD subs. It stands in the way of their getting revenue, and so these subs and others have won government contracts, but they can't be awarded the contract until there's a CMMC score that's been posted and they've been reviewed. So it's something that is, I really wasn't especially on my radar last year, but I'm just seeing in the market companies that are focused on this and helping their subs, like manufacturers. It's a very high growth business, and as a result, investors are bidding up these companies that are focused in that area. So it's kind of a new update.
And I'm going to throw a shameless plug in there with it, and also just share my insights on that. So one, if you're looking to prepare your customers for CMMC, CIS controls, or other things, VCIO Toolbox could take care of you. But putting that aside, what we're really seeing though is I'm starting to see my customers that are doing that, converting that into an as a service offering. So it takes away that project piece of it. I know people getting $25,000 to $50,000 for doing a CMMC preparation assessment, not even the remediation work involved, depending on the size of the contractor. And they're turning that into a high value recurring contract, $5,000 a month to do ongoing recurring, $10,000 a month, and then bringing in some of the inspection tools that are needed as well, that these companies might not be able to reach up and grab, and building it into a very viable, high value, what's the word I'm looking for? Like high touch, but also like high security. You're not going to get shown the door very quickly on that. And it's low touch for your team often, because it's a lot of data coming in and then an analysis with it. So when folks are really looking at how the next generation of MSP can expand their revenue, how can they get to those different volumes? It's not just about those security tech stacks I hear everybody talking about, and how you can bring in some more tools that bring you up to the $300 a seat or whatever we hear, but it's really getting focused and saying, how am I going to solve the problems for the customers? How am I going to help them achieve and demonstrate what they need to security wise? Because to your point, Abe, they might not be able to do business that is the core of what they do. If you can't get to level 3 maturity, you're not even going to do business with the DoD. And if that's where your business is coming from today, that's a problem, right? I'll also add in this, Abe, and this might be interesting for you. There are states now adopting these certifications as a way to avoid punitive damages if a cyber event happens. So Connecticut, where I'm a resident of, was one of the first states to do this, along with Utah and Ohio. This just legislation here in Connecticut just went into effect on October 1st. But now if companies adopt the CIS version 8 standard or the CMMC standard and start implementing those controls and can prove they're managing to those controls, if a cyber event happens, they can't be held for punitive damages. This is obviously very important for the companies, because the companies themselves now know that this might not force them completely out of business. And think about the big problems we're having with cyber insurance. Not that I'm ever looking out for the insurance guys, but the reality is this puts a fence around the claim. You now know it's going to be the cost of remediation and maybe credit monitoring or whatever comes out to the direct recipients, but you can't get that long tail of any of the companies affected downstream can now sue you punitively, putting that company out of business and putting a lot of extra pressure on the insurance company. Thus, in return, our rates or even our ability to get cyber liability insurance. So I expect that we're going to see more of that out in the marketplace, and this is going to make it a very hot item for MSPs. If they want to get into compliance as a service as part of their game, now is the time, and the time is early. There's a lot of opportunity out there.
Yeah. That's awesome that you've taken a leadership, been a thought leader in that, and have prepared your business to help support MSPs with that, because your timing couldn't be better. I mean, I have worked on a transaction over the past few months where a MSP/MSSP was growing at almost growing MRR at almost 200%. The demand's so big. Another one in the 60s. Like it's a great high growth area. And really
I know a couple of firms that literally opened up their doors with some talent behind them, and we're at $2 million a year inside of 12 months. And you don't hear that happening in the MSP world, where you hang out your shingle and you could be at $2 million in revenue at the end of year 1, right? Some of it's contacts, friends and family, but I don't know many companies that get to 2 million on friends and family.
That only gets you so far.
And we're all better off too, because it's really helping, protect that information. It's just good for the whole ecosystem.
Awesome. Perfect. I was just going to ask you any other parting thoughts.
Yes.
One other real quick one. Make it worth it for everyone to wait till the end. Thursday, November 11th. Connect IT Nation's connect-wise, in Orlando, there will be, this year, we didn't have it last year, an MSP deal crawl, where in a large room, buyers will each get a table, a couple people from each buyer, and sellers will circulate from table to table, kind of meeting. It started in 2018. I participated in 19. We'll do it again this year on November 11th. It's a great event if you'd like in a very confidential manner, like everyone signs NDAs before going into that. And it's a great way to have a lot of conversations in a very short period of time and kind of see if there is a fit, just kind of people fit between buyer and seller, and have resources around to help facilitate. But that and I want to say there's a 6-7 track program going on at that Orlando event related to M&A. If somebody is new to M&A or they're trying to do add-on acquisitions, that's hands down upcoming one of the most important places to be. And look forward to reporting back after after going through it this year.
Yeah, interesting. Oh, that's great. I had not heard that.
Well, I will be down that way, Abe, and I'll be sure to make sure that we connect live down in Orlando.
Awesome.
Tim, you coming down?
I will most likely be down there. It's with DattoCon, and we were gonna go out there, and that's virtual now, so that kind of changed our plans. So it was a bit of a kink, not in a bad way. Just I would assume that we will be down there. Yes, it's a lot of words to say. Yes, probably.
Awesome.
All right. So Abe, this was great. Always appreciate you coming on board and sharing information.
Thanks,
For those that that are listening as opposed to watching, there were a few links that we'll pull together and we'll post up there. We'll make sure you get to the articles that Abe pointed out, so you can see some of that data about some of the MSPs that are part of PEGs. You might know some of those names and not even known that they were part of the private equity backed platforms. And we'll certainly make sure that we post up something, Abe, if you can get me information about the pub crawl, so we can or the
I'll do all.
Yeah, we can do that as well.
Okay.
Yeah.
You have any closing thoughts, Abe, before we pass it to Tim to wrap us up?
Yeah, I greatly appreciate the opportunity to visit with you both and speak to your audience.
Yeah, it was
but
great.
We love having you, and can't wait to see you again soon with more great information to share.
I'll be a three-peat next time. Huh?
That's it. That's
you'll be the first one.
Right. Gives us a little time to design the robe, right?
Yeah,
exactly. That was fun. Thanks, guys.
As always, really appreciate you coming on. Like we say at the end of every podcast, this podcast will be available at any platform where you can get your podcast, up to and including YouTube. And for anybody out there listening, I would recommend going to YouTube on this one to look at some of the slides that Abe put up for us, just to put it in context and help you out from a visual aspect as well. Other than that, Abe, it was great having you on. Really look forward to having you on again.
Tim, you did that great. I don't think we need Robb anymore, so you can let him know.
This is my first go. I was trying to think, what does Robb usually say? Yeah. So yeah.
All right. Well, Abe, thank you so much, and we look forward to seeing you again in the future. Take care.
Okay.